Let me tell you something that most financial advisors won't admit. You don't need millions of dollars to retire comfortably. You don't need 2 million or 3 million or 5 million like the retirement industry wants you to believe. If you're over 60 and you're willing to live modestly but comfortably on $50,000 per year, I'm going to show you exactly how to make that happen. And I'm going to show you how to do it in a way that's safe, sustainable, and doesn't require you to become a stock picking expert or take excessive risk with money you can't afford to lose. This isn't theory. This is a practical plan based on 8 decades of investing experience and a deep understanding of what actually works when you need your money to last for 20, 30, maybe even 40 years of retirement. Today I'm going to walk you through every detail. How much capital you need, where to invest it, how to generate the income, how to protect against inflation, how to make sure you never run out of money, and most importantly, how to sleep well at night, knowing that your financial future is secure even if the market crashes or the economy goes into recession. Before I get into the specific plan, let me tell you a story that shaped how I think about retirement. It was 1976. I was in my mid-40s, and I had this realization that completely changed my relationship with money. I was already quite wealthy by that point. Berkshire Hathaway was doing well. I had more money than I could ever spend. But I started thinking about what would happen if I lost it all. If through some catastrophe I was back to zero, how would I live? How much would I actually need? I did an exercise where I calculated my family's essential expenses: housing, food, utilities, insurance, health care, basic transportation. Nothing fancy, no luxuries, just a comfortable middle-class lifestyle. And the number was surprisingly low. Even adjusting for inflation to today's dollars, we could have lived comfortably on about $50,000 to $60,000 per year. Everything above that was gravy. Nice to have, but not essential. This realization was liberating. It meant that financial security wasn't about accumulating the maximum possible wealth. It was about having enough to cover your needs with a modest margin for comfort and emergencies. And if you could generate that amount reliably from a conservative investment portfolio, you were financially independent. That's the mindset I want you to have as we go through this plan. We're not trying to get rich in retirement. We're trying to secure a comfortable lifestyle that you can maintain for the rest of your life without financial stress. Now let's talk about the first question everyone asks. How much money do I need to retire on $50,000 per year? And the answer depends on a few factors: your age, your health, your other sources of income like Social Security, and your risk tolerance. But I'm going to give you a framework that works for most people. The traditional rule of thumb in retirement planning is the 4% rule. This says you can withdraw 4% of your portfolio value annually and have a very high probability that your money will last at least 30 years. So if you need $50,000 per year and you're relying entirely on your portfolio with no other income, you'd need $1,250,000. 4% of 1,200,000. 50,000 is 50,000. Simple math. But here's where most retirement advice stops. They tell you the number you need and assume you'll figure out the rest. But the reality is much more nuanced. First, most people over 60 are going to receive Social Security. Let's say you're entitled to $24,000 per year from Social Security. That's a fairly typical amount for someone who worked a full career at average wages. Now you only need your portfolio to generate $26,000 per year. At 4%, that means you need $650,000. That's half of what you need without Social Security. This is a crucial point. Social Security is an incredibly valuable asset. It's inflation adjusted. It lasts for life. It's backed by the federal government. It's essentially like having a pension. For most people, Social Security will cover 40 to 50% of retirement expenses. Your portfolio only needs to cover the rest. Second, the 4% rule is actually quite conservative. It was developed based on historical worst-case scenarios. If you retired in the worst possible year, like 1966, right before a terrible bear market and high inflation, 4% withdrawals would have allowed your portfolio to last 30 years. But in most retirement years, historically, 4% withdrawals would have allowed your portfolio to not only last 30 years, but actually grow substantially. In other words, 4% is a floor, not a ceiling. With smart investing and some flexibility, you can likely withdraw more than 4%, especially if you're willing to adjust your spending in down years. Third, the capital you need depends on your age. If you're 60 and retiring early, you might need your money to last 40 years. That requires more conservative assumptions. But if you're 70 and just starting to draw on your portfolio, you might only need it to last 20 or 25 years. That allows more aggressive assumptions. For this plan, I'm going to assume you're 65, which is the traditional retirement age. You're receiving Social Security of about $2,000 per month or $24,000 per year. And you need your portfolio to generate another $26,000 per year to reach your target of $50,000 total income using the 4% rule. That means you need about $650,000 in investable assets. Now, I know that's still a lot of money. Many people reading this don't have $650,000, but stick with me because I'm going to show you how to build toward this number if you're not there yet. And I'm going to show you strategies that allow you to retire with less if you're willing to make some adjustments. Let me talk about the investment strategy. This is where most retirement advice goes wrong. Financial advisors love complexity. They put retirees into complicated portfolios with 15 or 20 different funds. International stocks, emerging markets, small cap growth, high yield bonds, REITs, commodities. And they charge fees on top of all this complexity. But here's what I've learned over 8 decades. Simple is better than complex, especially in retirement when you need reliability and you need to sleep well at night. My recommended portfolio for someone over 60 retiring on $50,000 per year is very simple. 3 investments. That's it. Just 3. First, 40% in a dividend-focused stock ETF. Specifically, I'd recommend SCHD, the Schwab US Dividend Equity ETF that I mentioned in previous discussions. This fund holds about 100 high-quality dividend-paying stocks. Companies like Chevron, Verizon, Pepsi, Merck, Home Depot. These are established businesses that generate substantial cash and return it to shareholders through dividends. The current dividend yield on SCHD is about 3.5%. These companies also tend to increase their dividends over time, which helps protect against inflation. Why dividend stocks for retirees? Because the income is reliable. You're not selling shares to generate income. You're collecting dividends. Even if the stock price drops, the dividends usually continue. During the 2008 financial crisis, the S&P 500 dividend dropped about 20%. That's significant, but it's much less than the 50% drop in stock prices. And the dividends recovered within a few years. Compare this to having to sell stocks for income. If you need to withdraw $50,000 and stocks have dropped 50%, you have to sell twice as many shares. You're locking in losses. With dividends, you just collect the dividend regardless of price fluctuations. Second, 40% in intermediate term treasury bonds or treasury bond fund. I'd specifically recommend IEF, the iShares 7 to 10 year treasury bond ETF. Why treasuries? Because they're the safest bonds available. They're backed by the full faith and credit of the United States government. The risk of default is essentially zero. Yes, if interest rates rise, the price of existing bonds declines. But you're not planning to sell these bonds. You're holding them for the income and stability. The current yield on 7 to 10-year treasuries is about 4 to 4.5%. That's solid income with maximum safety. Why not corporate bonds with higher yields? Because retirees can't afford credit risk. If you own corporate bonds and the companies run into financial trouble, you could lose principal. With treasuries, you know exactly what you're getting. The safety and predictability are worth accepting a slightly lower yield. Third, 20% in cash or short-term treasuries. This is your emergency fund and your buffer against market volatility. I'd keep this in a money market fund or treasury bills yielding about 5% currently. This cash serves multiple purposes. It gives you spending money for the next 1 to 2 years. So you're never forced to sell stocks at the wrong time. It gives you a cushion for unexpected expenses. Medical bills, home repairs, helping family members, and it gives you dry powder to buy stocks if the market crashes and presents opportunities. And so that's the portfolio. 40% dividend stocks, 40% intermediate treasury bonds, 20% cash. It's simple. It's easy to understand. It's easy to maintain. And it's designed specifically for retirees who need income and stability. Now let's talk about how this portfolio generates the income you need. Let's say if you have $650,000 to invest, you put $260,000 into SCHD at a 3.5% dividend yield that generates $9,100 per year in dividends. You put $260,000 into IEF. At a 4.2% yield, that generates $10,920 per year in interest. You put $130,000 into cash. At 5%, that generates $6,500 per year in interest. Add it all up, $9,100 plus $10,920 plus $6,500 equals $26,520 per year. That's almost exactly what you need. Plus you have Social Security of $24,000. Total income is about $50,500 per year. Perfect. Now, here's the beautiful part. You're living entirely off the income from your portfolio. You're not selling shares. Your principal is intact. If the stock market drops, you don't care because you're not selling stocks. You're just collecting dividends. And the dividends are much more stable than stock prices. This approach also protects against the sequence of returns risk, which is one of the biggest dangers in retirement. Sequence of returns risk means that having poor returns early in retirement can devastate your portfolio because you're withdrawing money at the same time the portfolio is declining. But if you're living off dividends and interest, not selling shares, sequence of returns risk is much less of a problem. Yes, your account value will fluctuate, but as long as the income continues, you're fine. And let me address inflation because this is a major concern for retirees. $50,000 a day won't buy as much in 20 years. How do you protect against this? First, Social Security is inflation adjusted. Every year your benefit increases to match inflation. This protects about half your income. Second, dividend-paying companies tend to increase their dividends over time, faster than inflation. Look at the track record of the companies in SCHD. On average, they've increased dividends by about 6 to 7% per year over the past 20 years. That's well above inflation. So your dividend income will grow over time. Third, when the bonds in your portfolio mature or you reinvest bond coupons, you'll be buying new bonds at current interest rates. If rates have risen because of inflation, you'll earn higher yields going forward. Fourth, you have flexibility. If inflation is high for a period, you can adjust your spending temporarily, cut back on discretionary expenses, travel less, eat out less. Then when inflation moderates, you can increase spending again. The combination of inflation-adjusted Social Security, growing dividends, and spending flexibility provides good protection against inflation. You're not going to maintain the exact same purchasing power every single year. Some years you'll be slightly ahead, some years slightly behind. But over a full retirement, you should be able to maintain a comfortable lifestyle. Now let me talk about what happens if you don't have $650,000. What if you only have $400,000 or $500,000? Can you still retire? The answer is yes, but with some adjustments. First, consider delaying retirement by a year or two. This helps in multiple ways. You accumulate more savings. Your Social Security benefit increases by about 7 to 8% for each year. You delay between 65 and 70. And you reduce the number of years your portfolio needs to last. Delaying from 65 to 67 increases your Social Security benefit by about 15%. That's like having an extra $50,000 in your portfolio in terms of income generation. Second, consider part-time work in early retirement. Working even 15 to 20 hours per week, earning $15,000 per year makes a massive difference. That's $15,000 you're not withdrawing from your portfolio. Over 10 years, that saves $150,000 plus growth. Many retirees actually enjoy some part-time work. It provides structure, social connection, and mental stimulation along with the income. Third, consider geographic arbitrage. If you live in an expensive area, moving to a lower cost area can reduce your expenses dramatically. Housing, taxes, healthcare costs vary enormously by location. Moving from California or New York to a state like Florida, Tennessee, or Texas could save you $10,000 to $15,000 per year in taxes and living expenses. That's equivalent to having an extra $250,000 to $375,000 in your portfolio. Fourth, consider downsizing your housing. If you own a large home with substantial equity, selling and moving to a smaller home or renting can free up capital for your investment portfolio. If downsizing releases $200,000 that you add to your portfolio, that generates an extra $8,000 per year in income at 4%. Plus you save on property taxes, insurance, maintenance, and utilities. Fifth, optimize your Social Security claiming strategy. If you're married, the higher earners should usually delay claiming until age 70 to maximize the benefit. The lower earner might claim earlier. This coordination can increase household lifetime Social Security benefits by tens of thousands of dollars. Sixth, scrutinize your expenses. Most people can cut spending by 10 to 20% without significantly impacting quality of life. Cancel subscriptions you don't use. Reduce dining out. Take less expensive vacations. Drive your car longer before replacing it. These small cuts add up. If you can live on $45,000 instead of $50,000, you only need about $500,000 in your portfolio instead of $650,000. The point is that retirement isn't an all or nothing proposition. There are many levers you can pull to make the math work, even if you haven't accumulated the ideal amount. Now let me talk about healthcare, because this is one of the biggest concerns and expenses for retirees. If you retire before 65, you need to bridge the gap until Medicare kicks in. Health insurance during this period is expensive. Premiums for a couple in their early 60s can easily run $12,000 to $15,000 per year or more. This is a real cost that needs to be planned for. Options include COBRA from your former employer, which typically lasts 18 months. Affordable Care Act marketplace plans, which can be subsidized if your income is low enough. Medicaid if you qualify based on assets and income, or paying full price for private insurance. Once you reach 65, Medicare significantly reduces healthcare costs, but it doesn't eliminate them. You'll pay premiums for Medicare Part B and Part D. You'll want a Medigap supplemental policy or a Medicare Advantage plan. And you'll have out-of-pocket costs for deductibles, co-pays, and drugs. A realistic budget for healthcare and retirement is about $6,000 to $8,000 per year per person. For a couple, that's $12,000 to $16,000 per year. This should be built into your $50,000 budget. If healthcare costs are higher than expected, you'll need to reduce other expenses or draw more from your portfolio. One strategy to manage healthcare costs is to keep your taxable income low. Many healthcare subsidies and programs are income tested. If your income is below certain thresholds, you qualify for help. With Social Security of $24,000 and portfolio withdrawals of $26,000, your gross income is $50,000. After standard deduction, your taxable income is fairly low. This can help you qualify for various assistance programs. Another strategy is to maintain a health savings account if you had one during your working years. HSA funds can be used tax-free for healthcare expenses in retirement. If you accumulated a substantial HSA balance, it provides a dedicated pool of money for medical costs. Let me now walk through a detailed year-by-year example of how this plan works in practice. You're 65. You have $650,000 invested, 40% in SCHD, 40% in IEF, 20% in cash. You're receiving Social Security of $2,000 per month, year one. You collect $9,100 in dividends from SCHD. You collect $10,009, $120 in interest from IEF. You collect $6,500 in interest from cash. Total investment income is $26,500. You collect $24,000 from Social Security. Total income is $50,520. You spend $50,000. You have a small surplus of $520 that you add to your cash position. During the year, let's say the stock market drops 10%, your SCHD position declines from $260,000 to $234,000. Your bond position stays relatively stable at $260,000. Your cash position is $130,000. Total portfolio value is $624,000, down from $650,000. But here's the key. You don't care. You're not selling stocks. You're collecting dividends. And dividends usually don't drop when stock prices drop. So even though your account value is lower, your income remains the same. Year two, the economy is in recession. Stocks are down another 5%. But dividend-paying companies continue paying dividends. Most of them even increase dividends slightly. Your dividend income goes up to $9,500. Your bond income remains stable at about $10,900. Cash income is $6,500. Investment income totals $26,900. Social Security increases with inflation by 3% to $24,720. Total income is $51,600. $120. You spend $50,000. You add $1,620 to cash reserves. Your portfolio value is now about $590,000 due to stock market declines. But again, you don't care because you're living off income, not selling shares. Year three, the recession ends. Stocks begin recovering. Your SCHD position rebounds from the lows. By year end, it's back to $260,000. Your total portfolio value recovers to $650,000. Your dividend income is now $10,000 as companies you own have increased dividends. Bond and cash income remain stable. Total investment income is $27,000. Social Security is now $25,462 after another inflation adjustment. Total income is $52,462. You spend $50,000 and add the surplus to reserves. This pattern continues year after year. Some years stocks are up, some years down. Some years inflation is higher, some years lower. But through it all, your income remains relatively stable. and actually grows over time. The dividends increase. Social Security keeps pace with inflation. And you never run out of money because you're not depleting principal. By year 10, your dividend income has grown to about $13,000. Bond yields have reset higher due to inflation. Your investment income is now $33,000. Social Security has grown to $31,000. Your total income is $64,000, well above your initial $50,000 target. And your portfolio value, despite 10 years of withdrawals, is still around $650,000 or possibly higher, depending on market returns. This is the magic of living off income instead of depleting principal. Now let me talk about the psychological aspect of retirement, because this is just as important as the financial mechanics. Many retirees struggle with the transition from accumulation to spending. For 40 years, you saved. You didn't spend. You deferred gratification. And now suddenly you're supposed to spend down your savings. It feels wrong. This psychological block causes many retirees to live far below their means. They have adequate resources, but they're afraid to spend them. They die with most of their wealth intact, having deprived themselves unnecessarily. The approach I'm recommending helps with this psychological issue because you're not spending down your savings. You're living off the income. Your principal stays intact. This feels more sustainable. You can spend the income without guilt because you know it will be replenished next quarter. Another psychological challenge is market volatility, watching your account value drop by $50,000 or $100,000 during a bear market is stressful, even if you understand intellectually that you don't need to sell. The way to handle this is to not look seriously. Check your account once or twice per year. Make sure the dividends and interest are being deposited. Beyond that, ignore the account value. It will fluctuate. That's what markets do. But if you're following this strategy, the fluctuations don't affect your lifestyle. I've been investing for over 8 decades, and I've learned that the investors who check their accounts least frequently tend to have the best returns. They're not tempted to make changes based on fear or greed. They stay the course. That's what you need to do in retirement. A third psychological challenge is adjusting your identity. For most people, work provides structure, purpose, and social connection. In retirement, you need to replace these. You need hobbies, volunteer work, social groups, routines that give your days meaning. This isn't a financial issue, but it's critically important for a happy retirement. Many retirees who struggle do so not because of money, but because they haven't figured out how to spend their time meaningfully. Think about this before you retire. What will you do with your time? How will you stay engaged? How will you maintain social connections? Having a plan for your time is just as important as having a plan for your money. Let me now address some common objections and concerns. First objection is, what if I have unexpected expenses? Major home repairs, helping children financially, medical costs not covered by insurance. This is where your cash reserves come in. That $130,000 in cash isn't just sitting there. It's your emergency fund. If you need $20,000 for a new roof, you take it from cash reserves. Then over the next few years, you replenish the cash by saving some of the surplus income or by selling some bonds. The point is that you have buffers. You're not living paycheck to paycheck. If you need to access capital, you can do so from your cash or bond positions without disturbing your stock holdings. Second objection is, what if dividends get cut? What if the companies in SCHD reduce or eliminate dividends? This can happen during the 2008 financial crisis. Many companies cut dividends. But SCHD holds 100 companies. Even if 5 or 10 of them cut dividends, the other 90 still pay. The overall dividend income from the fund might decline 10 or 15% in a bad scenario. That's manageable. you'd need to reduce spending temporarily or draw from cash reserves. But within a year or two, dividends typically recover, and companies that maintain dividends through hard times often increase them substantially afterward. Third objection is, what if interest rates drop and bond yields decline? Right now, intermediate treasuries yield about 4%. What if rates drop to 2%? This would reduce your income. But if rates are dropping, it's usually because the economy is weak and the Fed is trying to stimulate it. In that environment, bonds serve their purpose as portfolio stabilizers. Their prices rise as rates fall, offsetting stock declines. You can sell some of the appreciated bonds to supplement income, and if rates are very low, you might shift some bond allocation to dividend stocks to increase income. The portfolio isn't static. You can adjust based on circumstances. Fourth objection is, what if inflation is much higher than expected? What if we have sustained 5 to 6% inflation for a decade? This would erode purchasing power. But remember, Social Security is inflation adjusted. That protects half your income. And if inflation is high, interest rates will likely rise to combat it. When your bonds mature or you reinvest coupons, you'll be earning higher yields. Dividend-paying companies can also raise prices and increase dividends in inflationary environments. You're not completely protected, but you're much better protected than someone living off a fixed pension. Fifth objection is, what about taxes? Won't taxes eat into my income? At $50,000 of gross income, your tax burden will be relatively modest. Social Security may be partially taxable depending on your other income. Dividend income is taxed at favorable qualified dividend rates, currently 0 to 15% for most taxpayers. Interest income from treasuries is exempt from state income tax, though it's federally taxable. After standard deduction and other deductions, your effective tax rate on $50,000 of income will likely be 5 to 10%. That's very manageable. And if you're charitably inclined, you can donate appreciated shares from your SCHD holdings. You get a deduction for the full market value and you avoid capital gains tax. This can reduce your tax burden further. Sixth objection is, what if I live longer than expected? What if I'm still alive and active at 95 or 100? With this strategy, longevity risk is minimal because you're not depleting principal. Your portfolio at 85 will likely be similar to what it was at 65, possibly larger if markets perform well. The dividends will have grown substantially. Your Social Security will have kept pace with inflation. You'll be better off at 85 than you were at 65 in terms of income. Even if you live to 100, you should be fine. Compare this to strategies that deplete principal. If you're withdrawing 4 or 5% of principal annually and living into your 90s, you risk running out of money. With the income approach, you don't have that risk. Let me now talk about what to do if you're not yet 60, but you're planning for retirement. The goal is to accumulate $650,000 by age 65. How do you get there? If you're 55 with 10 years until retirement, you need to save about $4,000 per month, assuming 6% annual returns. That's aggressive but doable for a dual income household in their peak earning years. If you're 45 with 20 years until retirement, you need to save about $1,500 per month at 6% returns. Much more achievable. If you're 35 with 30 years until retirement, you only need to save about $600 per month at 6% returns to reach $650,000. The younger you start, the easier it becomes because compound interest does more of the work. The key is to start now, whatever your age. Even if you can't save the ideal amount, save something. Every dollar you save today is worth significantly more in retirement than dollars you'll have to earn later. And focus on reducing expenses during your working years. Every $1,000 you can cut from annual spending in retirement reduces the capital you need by about $25,000. That's powerful. If you can live on $45,000 instead of $50,000, you only need about $500,000 instead of $650,000. That's $150,000 less to accumulate. For many people, it's easier to reduce retirement expenses by $5,000 per year than to save an extra $150,000. Think about that. Downsizing to a smaller home, moving to a lower cost area, driving older cars, taking less expensive vacations. These choices can dramatically reduce how much capital you need. Let me close with the most important principle of all. Retirement security isn't about having the most money. It's about having enough to cover your needs with a margin of safety. And it's about structuring your investments to provide reliable income that lasts as long as you do. The plan I've outlined today does exactly that. $650,000 invested in 40% dividend stocks, 40% bonds, and 20% cash, generating $26,000 in annual income from investments, combined with $24,000 from Social Security, providing $50,000 total annual income. Sustainable indefinitely without depleting principal, protected against inflation through dividend growth and Social Security adjustments. Simple to implement and maintain, low cost, stress. This is how you retire on $50,000 per year, not through complicated strategies or high-risk investments, through simple, time-tested principles, dividend-paying stocks for growing income, government bonds for stability and income, cash for emergencies and opportunities, and Social Security as a foundation. And if you're over 60 and you're worried about retirement, stop worrying and start planning. Calculate how much you need based on your expected Social Security. Start building your portfolio with the allocation I've described. Live modestly but comfortably, and trust that if you follow this plan, you'll be financially secure for the rest of your life. I've been investing since 1942. I've seen 14 recessions, multiple bear markets, periods of high inflation, financial crises, and every economic challenge imaginable. And through it all, the principles I've shared today have worked. High quality dividend, stocks, government bonds, adequate cash reserves. It's not exciting. It's not glamorous, but it works. That's what matters in retirement. Not excitement, reliability, not maximum returns, sufficient returns with minimum risk, not complexity, simplicity. If you take nothing else from this, remember this: you don't need to be rich to retire well. You need to be smart. Smart about your expenses, smart about your investments, smart about claiming Social Security, smart about managing risk. Do these things right, and $50,000 per year is absolutely achievable. $50,000 can provide a comfortable retirement if you're disciplined and if you follow a sensible plan. Start today. Review your current situation. Calculate what you need. Begin building your portfolio and move toward the retirement security you deserve. You've worked hard your entire life. You've earned the right to retire with dignity and without financial stress. This plan will get you there. The opportunity is available to anyone willing to be disciplined, patient, and focused on what actually works rather than chasing fantasies of unlimited wealth. That's my message to everyone over 60. Retirement on $50,000 per year isn't just possible. It's completely achievable with the right plan. And the right plan is the one I've shared with you today.